Yeah, hi. Good evening to everybody who's been kind enough to join us. Absolute pleasure to invite or to welcome Anup, one of the stalwarts of the capital markets industry and especially mutual funds over many, many years. Anup is a well-known name. We spent nearly 25, 23 years with DSP before moving to IIFL. We asked Anup a few questions. And again, welcome to all our listeners from Scripbox, from within the Scripbox family and others who've joined us. The intent of these conversations is to ask an expert to tell us about what they think about markets, what they think about volatility, sort of put themselves in your shoes and answer any concerns you have and how to look for opportunities. So we asked Anup if he could tell us what does he think about the volatility, this disconnect between the economy and the stock markets. What should an investor be doing? What should an investor be thinking? And on behalf of, so I won't take up too much time. Anup is a great presenter. The format is that Anup is going to talk us through a couple of slides on a couple of topics. Should take about 30 minutes, Anup. And post that, we'll be open to questions. We are trying a new format as we are learning these things. You all are watching a YouTube streaming video. We are noting down all your questions. And as always, if you're not able to answer all the questions within the session, we will note them down and we'll try our best to get back to you with our responses to our social media handles. So without much further ado, over to you, Anup. Welcome on behalf of Scripbox and the family.
Thank you so much, Atul, for that introduction. And I've got to start off to thank you and the Scripbox to provide this platform for your listeners and myself to connect. So really appreciate that and look forward to an engaging session over the course of the next 45 minutes or so. Just as a backdrop, as Atul mentioned, I've got a few slides to take you through. And the background to those slides essentially is in my 25 years of investment management, I think one question or a set of questions that I got very often which keep coming to me in very different forms, really. And those three questions essentially were, is this the right time to invest? What returns could we look forward to over the course of the next 12 months? And what is the downside over the course of the next 12 months? And for some reason, people tend to think more in 12-month dimensions. So we got that question so often that we decided to put it on a slide and actually make that the first slide of all our presentations. And we call it time, volatility, and returns. So the questions essentially are on three dimensions. Is this the right time to invest? So that's time. So what returns can we expect? So that's returns. And what is the risk or downside, which we measure as volatility? So those are the three variables that we effectively threw onto one slide. And through that slide, I'd like to take you through how best we can provide some perspective. We can never provide perfect answers, but we can definitely provide perspective. So let me just go straight into that presentation. Hope you can see it.
Clearly visible, yeah. I know we can go for it. Yeah.
Okay, so what we did was, first to explain the first sort of set of variables. So what we did was we took the Sensex over the last 30 years from 1990, and then we tried to plot first the returns. And this blue line represents returns, and I'll explain exactly how this works. So these are, you'll see on the x-axis different periods of time, 1 year, 2 year, 3 year, 5 year, 7 year, and 10 years. And these are rolling periods of time. And I'll just explain in a minute what that means. And then we've plotted the blue line, which is the returns from the index, which is roughly in the 10 to 15% range, quite consistently actually, across these time zones. So let me just try and explain this point. So let's say the 1 year number that you see there is about 14%. So what we've done to calculate 1 year rolling returns is that for every day of the last 30 years, you've taken the 1 year performance day after day, each day, 1 year performance later, 1 year later, what the performance was. And of all that set of data series, we've then taken the median, which is the most commonly experienced return. And that gets plotted onto this graph. So this graph really represents the most commonly experienced returns across these rolling periods of time over the last 30 years. So it's pretty consistent in some ways. But if we look at volatility, which is the variation in the market, over these same periods of time, what we get is this yellow graph, which is clearly looks extremely different. You'll see the 1 year volatility of the market is as high as 35%. And interestingly, this number keeps declining as you stretch out time. This number keeps heading lower. But right up front, what this sort of slide tells us is a couple of things. If you look at the 1 year volatility, right up front, it tells us that anyone trying to predict the market on a 12-month time frame can be extremely off target. And in my 25 years of investment experience, I haven't come across really anybody who's been able to consistently predict where the market will be in a 12-month time zone. I mean, there are a lot of predictions that are out there, but you don't really see any consistency in terms of anyone being able to predict it correctly. Yet we spend a lot of time and energy trying to understand that. But the fact is, with 35% plus volatility, there are just too many events in the short run that you cannot predict, which can cause all sorts of market behavior. The other thing this slide tells us is, equities as an asset class is probably not even worth investing into from a 1 year time frame. Because, why would you buy an asset which has a 15% probability of return, let's say, with 35% risk attached to it? Yeah, the risk reward seems totally against you. It's almost 2:1 against you. So obviously, the shorter the time zone, equities actually doesn't make too much sense. But as we start stretching out the time, you'll notice, as I said, the volatility, the yellow line, keeps trending downwards. And what we've observed is from around the 6th year onwards, at least for the Sensex, the return line starts exceeding the risk line. And logically, when you buy any asset class, what you're looking for is a risk reward in your favor. You would want the returns to exceed the level of risk that you're effectively taking. So just mathematically, if we go back over the last 30 years on the Sensex, this has been the average experience from the market. 6-year investing and beyond produces a better risk reward relationship. A lot of people keep asking the question as what is long term? I think this is more a mathematical representation of that. 6 years and above just improves the odds of a more positive outcome relative to the risk that you're taking. Interestingly, if we plotted the same chart for funds, for actively managed mutual funds, on average, the blue line would be higher because most actively managed funds have outperformed the index. And the yellow line would be roughly similar. The volatility of funds is not very different from that of the index. So the cutoff point would be slightly ahead. So it would be about 4.5 years would be the cutoff where the risk reward has looked more favorable for investing into a mutual fund. And interestingly, at least as for the bulk of my investing life of the funds that we managed, we didn't have any 5-year period in our history of the last 22 years where we had a negative return in any 5-year cycle. So the risk reward was clearly positive as soon as you stretch your dimension to 5 years. So the challenge that exists in our market is that most people come in for the blue line. Effectively, that is what equity is sold as. It's a 13 to 15% potential asset class return. So they come in looking for the blue line, but they actually experience the yellow line up front. And you experience the volatility of the market as you invest. And if you're on the wrong side of volatility, of course, it can be extremely painful. So most people actually we've observed, especially if you're investing after the markets have done very well, end up experiencing the negative side of volatility, and then they don't even last that period of time. In a few years, they may have a bad experience and actually exit the market. Whereas what you should be doing is really giving it time, because as you give it more time, you'll start experiencing the real returns that the market have to offer, and the risk reward keeps improving for you as time passes. So, we often say, therefore, that, the returns is the easier part, actually, because it's fairly stable if you give it the right perspective. The problem is living through the volatility to get to those returns. And that's where the risk of markets is actually entirely in control of the investor. When people say, what are the risks? The risks really are entirely in your control. If you give it time, most of the risks tend to dissipate, and you start experiencing the underlying fundamentals of the companies that you're buying into. So that's really one of the key points to understand, which is that's why they also say time in the market is more important than timing the market. And this graph really represents that concept in many ways.
Thanks, Anup. I mean, just on behalf of the Scripbox listeners, I think if you could somehow explain this to people when they start investing and they can start appreciating this, I think a lot of the conversations and a lot of the angst and pain which all investors feel would go away. Right? I think so. Thank you. I mean, this is really, really powerful. I'm sure there'll be questions from the team as we go forward. But yeah, without interrupting any further, hand over to you. But this is really a great way to understand that it's difficult to time the market. However hard you try. Thanks.
Absolutely. Now, having said that, I'm going to try and sort of, when we present this graph, we do also get a question that, okay, this is fine, but for some people, this may not look terribly exciting. And is there any way to try and enhance this risk return graph? And, to our mind, obviously with 35% volatility, you can't necessarily get the market direction right in a short-term period. But what we have seen is that you can use valuations and ranges of valuations to try and improve this graph essentially. So what we've observed is that, when we look at valuations, we look at a simple concept of price to book ratio of the market. Now, what is the price to book ratio? Price to book for, let's say, a company or a stock market is nothing but the price of the company in relation to the net worth of that company. And people look at PE very often. That's the more commonly used term, price to earnings. But frankly, the problem with price to earnings is it just looks at 1 year's earnings, and it can be very volatile, especially at times like these. It may misrepresent the actual earnings power of a company. And therefore, we prefer price to book as a more stable measure. Now, what we've observed is that markets tend to have a certain rhythm to them, or there are certain cycles that we observe globally, not just in India. And every decade or so, you will have an extreme bull market or bear market or both typically happen. And in those cases, markets stretch to extremes of valuation. Now, you will never catch a bottom or a top, but zones in which the risk reward starts working for you or against you. So what we observed was that when the market comes to a 2 times price to book range, 2 times price to book or below, the odds tend to improve considerably for you. And this blue line actually moves up dramatically in terms of future returns. And the yellow line is actually a lot lower. And frankly, unfortunately, at 2 times price to book, your perception will be the exact opposite. You'll be feeling very scared of volatility. You'll be feeling very fearful of returns. But at those points, the blue line is actually far superior and the yellow line is a lot lower. And conversely, when you're buying this market at 3.5 times price to book and beyond, actually you're buying a lot more of the risk and much less of the return. So we've seen these ranges, and it doesn't happen all that often. As I said, these things happen a few times in a decade, but that is the time to really take a view on asset allocation and perhaps, bring that element of, very rare but required timing in terms of your overall exposure to equities at that point because of the broad risk reward that you're likely to see. So we actually have this in my next slide, just to give you a perspective on that. This is where we are at today, in fact. Just very recently in the March correction, we had fallen exactly to below 2 times price to book. Just to give you that number on the Nifty today, for instance, the book value of the Nifty is 4,200. So as the market fell to 8,400 and below, it went even further down. But at 8,400, it was 2 times price to book, and then it actually slipped below. But in those zones, if you look at the the data below, you notice that over the last 20 years, the market has been priced at less than 2 times price to book only 5% of the time. And whenever you've bought it in that zone, the next 5-year returns have been as high on average of 40% annualized. So it's been far superior risk reward when the market is at 2 times price to book. And as I said, it doesn't happen too often. You'll notice over the last 20 years, it's happened only a few times. Once in 2002-3. This was a fairly long period of time to have to tolerate low valuations, but it was well worth it. And then you've had a couple of instances in 2008-9, and now more recently in March, we just had a very brief moment of it going below 2 times price to book and coming back. Most of the time, the market is between 2 and 3 times price to book. 52% of the time it has spent in that range over the last 20 years. Today, we are at about 2.7 times price to book with this rise. So we are now in a more normalized outcome of expectations. This is typically the average return when you're investing between 2 to 3 times price to book. It's roughly in this range. So we'd say now equities are in a more normalized zone of return. And then as markets go higher beyond 3 times, and as I said, 3.5 times and beyond, the risk reward starts reducing. So above 4 times price to book, the market has been there for just 12% of the time, and the future returns come down all the way to 4%. So the higher is sort of the valuation of the market that you're buying into, and particularly above 3.5 times price to book is where we would normally raise a cautionary flag. It's not a top necessarily, but beyond that, the risk reward is not in your favor. And you can see very clearly that the returns tend to be subpar, whereas, at 2 times price to book, it is far superior. So right now we are in that zone where, returns are still interesting enough. I mean, compared to what we're seeing in fixed income, but I think it's clearly a much, much more normalized behavior. So I think we're now more in line with the blue line that I showed you on the first chart. That's pretty much the sort of expectation that we would set for investors at times like these. So that just gives you a quick perspective on time, volatility, returns. And as I said, when you're between 2 and 3 times price to book, I think it just makes sense to just stay invested. As you get closer to 2 times price to book, it makes sense to probably move from SIPs to lump sum investing. And for the most part, you're just better off probably investing systematically and not really bothering about trying to catch intermittent corrections. I think that really doesn't add much value because, as I said, volatility in the short run is very, very unpredictable and doesn't really add much value. And it's only when valuations go above a certain point that you have to then start thinking the other way. So that's a quick perspective on the past and the current scenario. What I thought I'd also add, Atul, if we have enough time.
This is really useful.
Yeah. Sure.
Apologies, I'll just 2 minutes bit for our customers. I mean, this is just reiterating our belief that SIP way is the way to go. We've just launched something called the Smart Transfer Plan, which allows people to put in a lump sum and then sort of time their, let it gradually come into the market. Because volatility is just so high, you don't know which side of the volatility curve are you going to get. Similarly, I mean, lump sum strategies exist for specific reasons, right? But trust your advisor. Don't try to do it all on your own is the other piece. But yeah, all yours to talk a little bit about the economy and looking ahead.
Sure. As I said, this is a session where we felt it's better to add perspective rather than very precise views because there's nothing very precise in our markets. But we did have one slide. I mean, I've given you a bit of a perspective on the past and where we stand today. But I thought it'd be worth just drawing into some future potential that we see and some interesting trends that might play out, and more specific to one sector, which we just wanted to highlight to you. We were trying to look at what are the big value creation opportunities over the course of the next decade. And one big area for India probably the most important sector as far as India is concerned is financial services, because that is almost a third of the index at this point. It's the single largest sector. And frankly, the way we see things is that if financial services doesn't do well, it's difficult to imagine the market or indeed even the economy doing well. What we've observed is, if you just take a step back and think about India as an investment opportunity, I mean, we of course are all here and we invest into our market, but why should someone sitting overseas want to invest into India? What is unique about the Indian market? Some of the key features that attract people to India is the fact that we have a high consumption driven economy. And of course, we have a very young population with that. And therefore, there seems to be a fairly long runway of future consumption. Now, the fact of the matter is that if consumption is India's core story or investment attraction, then financial services are very closely attached to that theme. And within financial services, particularly the consumer lending piece, because consumer lending in a way is going hand in hand with that increase in consumption. Just to give you an example, I mean, if everyone's familiar, I'm sure, with Bajaj Finance, it's been one of the best performing stocks of the last decade. And if you go back in time, 10 years ago, when Bajaj Finance had just about started consumer lending, prior to that, they were doing largely two-wheeler financing. When they got into consumer lending at that point, of all the consumer durables being sold, less than 10% of those consumer durables were sold on financing. Today, almost half of all consumer durables sold are financed. So clearly, as financing comes through, consumption also starts accelerating. And particularly with the younger demographic, I mean, they're quite comfortable buying things on EMIs, on financing, and wanting to have those things earlier in life. So consumption and consumer finance pretty much, as I said, go hand in hand. So we thought we'd just talk through a little bit about how big this opportunity is on the consumer lending side, and therefore it will obviously result in some good value and wealth creation. So let me just give you a big picture to start with. So India's GDP today, prior to COVID, is 210 trillion rupees, roughly $3 trillion, or 210 trillion rupees is India's GDP. If we look at the overall lending, the entire financial services industry and the total lending that they have done, the entire system, including all banks, NBFCs, everybody, it comes to a total lending book of about 120 trillion rupees. Now, this lending tends to happen to two forms of borrowers. There are corporates who borrow, and then there are individuals who borrow. So we call it corporate and retail. Corporates account for 73% of these total loans, and retail individuals, all of us, account for 27% of these total loans outstanding. So the total retail borrowing in India is 32 trillion rupees. Now, if I look at that number in the context of our GDP, so 32 trillion in the context of 210 trillion GDP, gives you a ratio of about 15% is India's retail credit to GDP ratio. And at 15%, India has one of the lowest retail credit ratios in the world. If you look across all emerging markets, most of them will be between 15 to 50%. If you move across to developed markets, you'll see retail credit to GDP ratios ranging from 50 to 100%. And we've seen this trend consistently world over. As an economy grows, the retail credit to GDP ratio keeps rising. So for India, about 7-8 years ago, this retail credit to GDP ratio was about 10%. Today, it's at 15%. And it's very clear to us that over the next 5-10 years, this number will be considerably higher. Now, the next question, though, is who are the consumers of this credit and why should it keep growing? And I'll just try and explain that. So in the boxes, the blue boxes that you see, that gives you the big picture. As a country, we are 1.3 billion people. In terms of number of homes or households, it's 267 million. So that's an average of 4 to 5 people in every home. Our per person income in India today is in dollar terms, $2,050. And of course, in India, unfortunately, looking at anything per capita doesn't really make sense because we have such a wide dispersion of income. So what we say actually is there are 3 Indias in India. India 1, 2, and 3, depending on the type of income profile that they have. So let me just try and describe that to you. So India 1 are the top 8% of these households. So 24 million households out of 267 million have a per person income ranging up to $8,000, from $3,500 to $8,000 is the per person income of the family. And interestingly, of that retail credit number that I mentioned to you, the total retail loans in the system, that 32 trillion number, of this 70% of this lending has gone to India One. So 8% of the households get 70% of the total retail loans in the system or retail credit, right? And in many ways, India One actually is probably 70% or two-thirds of pretty much most of consumption. So I'll just give you some very simple anecdotal evidences that we normally put out to give a perspective on that. So let's say India One, as I mentioned, is 24 million homes. If we try and convert that into number of customers, how many people are, how many consumers are there in India One? What we do is we normally measure this number, we multiply this number by 2. So we assume that there are 2 people who are dominant consumers in any household. So if I take 24 million multiplied by 2, it gives us 48, let's say 50 million consumers in India One. Now let's try and correlate that to a few numbers that we should be more familiar with. So for instance, how many Indians have a passport today as a measure of their ability to spend, consume, travel, etc.? There are just 75 million Indians who have a passport. How many Indians file taxes? Around 65 million Indians file taxes. Not all of them even pay the taxes, just file, but 65 million Indians pay taxes. How many credit cards are there in issuance? A little over 50 million credit cards totally outstanding. And here I'm not even counting the 2 or 3 cards that each of us may have in our pocket. It's just 50 million total number of cards. How many cars are there on the road? Totally about 30 million. How many demat accounts are there? About 40 million. So, you know, when you look across these numbers, what you realize is that the core consumption base of India, in terms of more higher value consumption, is in the range of maybe 50, 60, 70 million consumers. And that's largely India One. And that's been driving a lot of the consumer lending so far and will continue to obviously grow. But what we're finding really interesting over the next decade is really the emergence of India 2 and India 3. So India 2 are the next 15% households, 40 million households, who have a per person income ranging from $1,200 up to $3,500. And today, 20% of the total credit goes to India 2. But what is interesting is in this, in this pyramid of India 1, 2, and 3, India 2 has actually been the fastest growing part of India over the course of the last 5 years. So India 2 has seen the maximum addition of households, and the highest GDP per person growth is coming from India 2. Now, the way we've seen this is just mathematically. If we assume that over the next decade, India 2 continues to grow at the same rate. So I'm looking beyond today's scenario of COVID and whatever air pocket we may have run into. But assuming we revert back, and over the course of the next decade, India 2 reverts back to where it was growing over the past 5 years, then what will happen is 10 years from now, the India 2 will effectively become the India 1 of today. That's the sort of income range they will be at. And to our mind, the way we see this is that India 2, 40 million homes, if we convert that again into consumers, multiply by 2, we get about 80 million, let's say 100 million consumers that we will potentially add into the system over the next decade, who will have rising consumption capability. And this is very rare. You won't find this in many economies in the world where they would be adding 100 million consumers of increasing consumption capability over the course of a 10-year period. I think this is going to be a very critical part of the whole India story in terms of consumption particularly. And then you have, of course, India 3, which is the large part of India, 77% of our population, 200 million people, 200 million households, who have a per capita income up to $1,200, so not too much of discretionary spending capability. And only 10% of the total formal retail credit goes to 77% of India. And the reason we have such a lopsided scenario is for a large part of time, India 3 actually didn't even have access to formal credit. I mean, it's incredible to think that till 5 or 6 years ago, half of the country didn't even have a bank account. And obviously, when you don't have access to formal credit, India 3 has had to survive largely on informal credit. As we all know, that comes at a much, much higher cost. And that keeps India 3 perpetually in the zone where they're unable to break out, because when you're borrowing at very high rates, it's very difficult to create an economic livelihood for yourself. But what we find very interesting, and I think this is going to be very important for India over the course of the next decade again, is that just given the fact that we've now, thanks to the Jan Dhan and the Aadhaar program, we have a situation where we've added 400 million bank accounts in the last 5-6 years. That is unprecedented globally. And today, a large part of the population now actually has a bank account. So credit models are being found into India 3 now. So all sorts of microfinance, affordable housing loans, gold loans, all sorts of micro loans, small business loans are getting into India 3 at definitely lower rates than what they were borrowing from the informal market. And that, I think, has the ability to change the whole economic characteristics of India 3, can uplift people and push income levels further, because your economics change dramatically when you're borrowing at 20% versus borrowing at, let's say, 40%. It just changes the economic outcome of whatever you're doing quite substantially. So we do see a very large potential even from India 3. And I think this is the sort of bright ray of hope potentially that we've sort of not been able to deliver for the last 50-60 years. But I think there could be an interesting transition over the course of the next decade. So when we actually add these three together, India 1 plus 2 plus 3, our sort of math suggests that we can grow retail credit at 15% per annum for every year over the next decade. And at the end of it all, we'll still be at a retail credit to GDP ratio of about 25-26%. And therefore, there's a lot of runway and room to grow. And with this, I think you'll have a lot of ancillary benefits of consumption, other sectors benefiting. But clearly at the heart of it will be this importance of getting financial credit across to a larger part of the population. And this is, I think, a very interesting opportunity over the next decade. And just given the weight of financial services in the index, I think that makes us quite optimistic about where markets could be over a period of time. So I think that was really what I wanted to discuss with you and provide that perspective as well. And just leave you with that thought. And I'll be very happy to take questions now.
Thank you very, very much, Anup. Because absolutely, I mean, we've had a few speakers and obviously we've learned a lot, but something so crystal clear, so easily laid out and so easy to understand and actually deep meaning is very, very powerful. I'm hoping all of our listeners have learned as much as I have. I mean, it's been phenomenal. The numbers are easy to read and understand and imbibe. From an investor's perspective, obviously, this means that the opportunity over the next 10 years in the Indian economy is amazing, right? Because if you combine what Anup said to begin with, that time in the market matters. Markets are well priced broadly, so just being there for the next 10 years. And given a lot of our customers are typically slightly younger, right? 36, 37, 35, even if you're 45, this is a great time to be participating and remaining invested, especially with this consumer story which Anup laid out. If 15% growth year on year is nothing to sniff at, the power of compounding really takes you very far. One or two questions from our side, Anup, and the perennial question, kitna deti hai, is the classical question everybody asks. So in spite of all of this, what's the sort of the 10-year outlook or 7-year outlook from your perspective? I won't ask you the short-term outlook in the next 2 quarters, 4 quarters. All of us are probably guessing. So the two questions I had is, one is this disconnect. So one is, what is your long-term outlook in the 7 to 10 year scene? And what is your outlook in the this disconnect between the economy and the markets? So first, about our long-term outlook and what could be the reasons behind the short-term sort of in a way disconnect, you see.
Yeah, sure. And, we're seeing this disconnect not just in India, it's pretty much a worldwide phenomenon. So India is really part of a global ecosystem in that respect. And what is common to the world at large at the moment is the fact that, this is a problem that's affected every economy. And we have a situation where governments have intervened in the system and have been providing large, almost unprecedented levels of liquidity, along with very low interest rates into the system. Whenever you do that, you are bound to create some asset inflation, and that's what we're experiencing now. Because there is a lot of liquidity, there is a lot of risk-taking ability, and there is also a view that as soon as you move your dimensions out in time, things will normalize. It's not like it will stay like this forever. In a long-term value of a business, if you have one bad year, that doesn't dramatically change the total value of the business over a period of time. It can push it back by maybe 10 or 15%, but it doesn't alter the entire value of that business. So I think the market's obviously looking beyond this crisis, and it's being partly given an extra boost by the fact that there's a lot of liquidity and low interest rates. So the thing we clearly watch out for is interest rate trends. I think that's going to be very critical to measure, how the market is being valued. But more importantly, I think eventually we've got to see how earnings come back. And interestingly, I think, for the last 7-8 years, most fund managers, including myself, have been terribly embarrassed by the fact that we used to start the year with a certain earnings expectation and always have to bring it down towards the end of the year. I mean, it had become such a painful cycle, and we'd always think the next year was the better year coming. But, post this sort of COVID scenario, what it has done is actually flipped that over, where I think going forward, we're going to start with very low expectations and probably end up being better. And I'm actually looking forward to that potential in the next couple of years, where people might actually underestimate the ability of the economy to bounce back. Because, through this phase, what corporates have done and what anybody would do is cut costs quite heavily. And you sort of start getting used to things. There's certain costs that you realize you didn't even need to have. And as things start normalizing, you will probably end up saving some of those costs and actually come out with even better economics than you had going into this problem. So I think that's one way to look at it. And therefore, I think, what the market's in a way doing is looking a little beyond just this phenomena. But there's no doubt that there's some external stimulus also that is causing some part of this movement that we're seeing today. Now, how would you plan for it? As I said in my first slide, I don't think anyone can predict volatility. I mean, most of our time in our business is spent on hindsight analysis, explaining why something happened. We all become experts after an event and explain it beautifully to you in terms of why it happened. But the ability to predict what's going to happen is very, very limited. And that's the nature of markets. I mean, that's the nature of the world. There's so many unknown things that will come up that you had never even thought about. I mean, who imagined COVID last year, for instance? So that's just the nature of things. But what really matters in all of this is whether businesses are still able to grow through time, and whether their economics still remain the way they used to be. And I think through all these crises, what we've observed is that eventually businesses bounce back, and stronger businesses bounce back even better. It's sort of a culling of weaker players that tends to happen. It's a bit of a Darwinian sort of phenomenon. So I think this is no different. And if you just sit with that price to book range and you focus on timing only when you're in those extremes, I think you're much, much better off. I mean, there is a value to timing when you are at an extreme of valuation. And for the most part, I would say for probably 80 to 90% of the time you spend in the market, you really, trying to time it won't add much value, as I said, while it's in this range. So today we're in that sort of range where trying to take a market timing call will add very limited value. I think it only makes sense if the market hits back to 2 times price to book or to 3.5 times price to book. At that point, exercising a view would be, I think, very useful. So that's a good thought.
Lovely. Thank you very much, Anup. Before we wrap up, we're nearly out of time. The final question in terms of, we always tell our customers that apart from timing the market, don't get hassled by daily movements of the Sensex, which you've clearly suggested. We also say, like you said, those who survive will thrive. The better players will come out bigger, and hence trust the fund manager. Right? I mean, because it's not necessarily that he has to follow the Sensex on a daily basis. If you are trusting the right fund managers, as the money comes in, they take positions on businesses they believe will do well. So just to reiterate that, the sort of the question from which we get asked often is this whole SIP versus lump sum. And from what I heard from you, I just wanted to get your confirmation, is that don't try to time the market, just continue with the SIPs and over the, hopefully next few period. So any final word from you, Anup, as we wrap up today?
Absolutely. And, I'd just say that, just to add to this, I think the next set we were thinking of doing is, even for individuals, when we think about markets and we spend so much time trying to figure out, is this the right time? Again, we're thinking of another chart, which maybe I'll sort of try and present to you on your next session, where, what we realize is even if you get your timing perfect, the amount of money you put at that point in time actually becomes more important. And very few people, you may have got the absolute bottom of the market, but the amount you would have invested at that point would be very minimal or very notional. It doesn't really move the needle for you. So for all that effort, you actually don't get much of an outcome either which way. And then a third derivative of that is you also have to select the right thing to buy, whether it's a fund or a stock. So it's very difficult for people to get all three consistently right. And therefore, we come back to the same point that the faster we reconcile ourselves to the fact that we don't really know. And all you know is that there are risk reward zones. And while you're in one, the best thing to do is to do nothing. But only at those extremes, it definitely makes sense. It adds value to actually do something. And that's the time you have to go against your instinct, because when markets are down, you will be more fearful. Whereas just imagine that blue and yellow line being reversed. And similarly, when markets are up, you derive a lot of comfort from that, but actually you're buying more of the risk and less of the return. So, I mean, just it's more like a psychology session really, but just want to leave you with that thought. It's important, to keep reflecting on this risk and return metric, just to provide perspective to where you are at, and how you're applying yourself to the market.
Thank you so much, Anup. It's been an absolute pleasure. The comments on our YouTube channel are really grateful to you for such an insightful session. Thoroughly enjoyed it. It's been fantastic. To all our listeners, remain invested, stay safe. This is a long-term game. We are here, we are watching. If we find these zones, be rest assured, we'll come talking to you. As always, thank you for your time, and we hope to see you again in the next session of our Expert Speak. So thanks a lot, Anup, and thank you everybody for listening. Have a lovely week.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.